Welcome back. Well, like we've been pointing out, the market's volatile, but the resilience is intact. And on a day like this, the market just down about 1/3 of 1%, which is fine. And the mid-cap index in green. We're talking to some companies now. Staffing companies are on our radar. The Naukri Job Peak Index has decreased 11% in August versus July, and the unemployment rate has increased to 8.28% from 6.8%. There's also a Goldman note which says that TeamLease and Kescorp will see strong revenue growth of over 20% over FY22 to 24, given increasing reliance on temporary staffing amid the uncertain macro environment. Ramani Dhati, CFO at TeamLease, is now joining us. Good morning, Ramani. Thanks a lot for joining us. If you could tell us first the trends in IT, because that's where the big growth was. But have the recent sort of developments, especially in the US, put a break on that?
No, definitely, because last year we had almost a 33-34% growth in IT staffing business of ours. And this year it looks like there is a slight slowdown, especially in IT services companies. So this year we are projecting upwards of 20% growth, but at the beginning of the year, our estimates were close to 30%. So compared to that, definitely there is a slowdown. As of now, from products and captives, we are still having very good number of open positions. I think that's also because the temporary gap between demand and supply, because many IT companies have kept a hold on their permanent hiring, and the interim requirements, whatever open positions and requirements that they have, they're fulfilling with temp positions. So with that, the temp staffing side, we are not seeing any substantial impact, be it in terms of IT staffing or ITES related. So upwards of 20% even this year looks like very much possible.
Okay, so you're saying that tech companies have now kept a hold on permanent hiring, but they're going ahead with temp hiring. Is that a 1 to 2 month phenomenon? I mean, any kind of leads that you're getting on how things may progress in terms of permanent hiring?
Yeah, so staffing works like a shock absorber whenever there is an uncertainty or slowdown. So things are not so certain, especially for IT industry. So they are relying more on temporary employees, the contract employees, rather than increasing their permanent employee force, because that's more like a fixed cost for them. So the temp staffing enables them to variabilize their cost, plan for uncertainties, the ease of hiring and firing is much better. So that's what is, we are seeing this trend from last few months, and it looks like almost till March, this kind of trend may continue with the IT.
Okay, so in terms of numbers, you had done about general staffing hires of around 13,600 in the quarter gone by. Any guidance, any average that you can share with us?
So we would be doing about 4 to 5% sequential growth quarter on quarter for the rest of the year, and almost 20 to 25% overall growth in general staffing business as well this year. We are again seeing a slight slowdown in few industry verticals, especially e-commerce, edtech space, the new age companies, private equity funded companies. There we are seeing some sort of slowness. Otherwise, the traditional companies, auto, engineering, manufacturing, banking, insurance, and post-COVID, the recovery in retail, hospitality, tourism, travel, those sectors are very good. So because of our very well-diversified portfolio, while there is slowness in some industries, so we are offsetting with the growth coming from other industries. Also, this has been aided by increase in preference for formal workforce. So that is reflecting in the data of EPFO and other indicators published by various agencies.
Okay.
In a way, what you're saying, I mean, not what you're saying, but the macro uncertainty is equal to more temporary hiring, is equal to better prospects for a company like TeamLease? Does that equate?
If the uncertainty is temporary, definitely yes. But however, if it turns more into like a recession, just like any other industry, we will also be taking a beating. But historically, if you look at the trend, whenever the times are uncertain only for a brief period, maybe 3 to 6 months kind of time frame, staffing companies have always benefited out of it.
On margins, your Q1 margins were weak, in fact, just about 1.3%. Has that reversed, and where do you think you can end the year with?
So we can end the year with similar margins what we have posted last year, which is close to 1.7, 1.8% for the full year basis. And that's also because, as we said, we have made some investments at the beginning of the year in terms of building our capabilities around sales, hiring, and other technology investments. Those have been fully absorbed. So from now, every quarter, there'll be a sequential improvement in margin, both in absolute terms as well as margin terms. However, the inflation being, kind of settling down, we should be able to see a sharper growth in our margin starting Q3.
Okay, we'll leave it at that. Thanks a lot for joining us and all the best for the rest of the quarters. Okay, that's the word coming in on hiring, but let's move on and talk about the banking space now. N. Kamakodi, the MD and CEO at City Union Bank, joins us to discuss an outlook on how their business is shaping up. Mr. Kamakodi, good morning. You know, the deposit momentum has been on the weaker side for a while. Can you give us an outlook on how the rest of the year may shape up?
Basically, in this year also, we expect the deposit growth may be slightly lower than the credit growth. And one thing what we have to keep in mind is that if you take a 10-year horizon roughly, 1/3 you will be having a deposit growth outpacing the credit growth, and 1/3 of the period when the deposit growth is lower than credit growth, and maybe for remaining 1/3 you will be having growth almost in tandem with the credit growth. So these sort of, like say, fluctuations are often given in the interest rate cycle, depending upon the liquidity position and like say how the central bank wants to have surplus liquidity and all. The rates get adjusted accordingly, and overall, I have not at least so far seen like say many instances when the growth of credit is impacted by not having sufficient funding and all. So this is something which is happening in every cycle. We need not take too much out of it. It's something which we have been seeing in every cycle.
So what does this mean in terms of loan growth? How much has the loan growth been so far for City Union Bank, and what is the projection for the full year?
We had closed first quarter with about 12% growth. At the beginning of the year, we said for the whole year, we will be having 12 to 15% growth along with the fourth quarter results of the last year. But along with the first quarter results, we said probably we will be closing the year with about 15 to 18%, where the bulk of the growth will be backloaded towards the fourth quarter, mainly because we expect the investment cycle to start as the capacity utilization is increasing, particularly in the SME front.
15 to 18% loan growth for full year FY23. What percentage of the lending book is linked to external benchmarks? Rates are rising in the system, right? Does it, what is the impact?
Basically, in every, as you see, almost maximum as much as more than 90% of the loan book is floating, either with the external benchmark or with the your what you call the other benchmark rate. So the already about 50% of the incremental rate had been passed on. So the you will be seeing during the interest rate increasing scenario, already we have also seen reports that surplus liquidity is totally absorbed and we are into the deficit thing. So it's an indication that rates will get firmed up. So there will be increase in the yield, and the deposits, particularly term deposits, they take longer time to reprice. So we will be getting into a period where the margins will be showing like say upward bias.
Your slippages had gone up quarter on quarter at about 270 crores in the quarter gone by. That was over a 22% growth. Any indication on asset quality? I mean, will there be a further increase in slippages, or do you think asset quality will be under control?
Basically, you are seeing quite a good improvement in the asset quality. Like say pre-COVID period, we typically used to have about like say 2 to 2.5% slippage for the 3 years prior to the COVID. But during the COVID years of 2021-22, we saw the slippage ratio coming to about 3 to 3.5%. But for the last 2-3 quarters, things have stabilized. More than slippage, there used to be issues with the recovery because courts and all were not functioning during the COVID period. That has improved, particularly if you take a credit for the write back of return of assets. The gap between the slippage and the recoveries have narrowed down, and so which means effectively you may not be requiring any incremental provision, as the reversal of provision itself will take care of the incremental provisions for the incremental NPA and all. But nevertheless, we will be continuing with the provisioning to get the net NPA level lower. In fact, we are seeing a good improvement in the NPA numbers, both in terms of the slippage and also in terms of the final numbers.
Mr. Kamakodi, good morning. You know, the big chatter in the market has been about the consolidation or likely consolidation in banks, and especially the ones which don't have any identifiable promoter. I mean, like yours, promoter holding is zero, right? It's owned by institutions. Do you think that's going to be a likely scenario going forward?
I am probably almost 20 years in the industry, and I am facing the same question for the past 20 years, and I am giving the same.
I'm asking the same question for the last 20 years. I am also in this profession for 20 years.
Basically, for any institution, be it bank or any business per se, as long as you are adding value to your stakeholders, be it customers, be it shareholders, be it employees, nobody can question your identity. And when we have seen in the past, you had not seen many consolidation where it was for the voluntary consolidation for the, like say, purpose of creating value and all. Even in hindsight, looks like those banks which merged themselves when we are doing well, probably they would have created more value had they maintained their identity. And all mergers had happened when there were serious issues with their performance and probably other complaints and other regulatory issues and all. So we, as our return ratios, be it ROA or ROE or growth or whatever way, is like say almost in top 10%. We don't see that as a strategy. We will be striving to move forward with like say growth and like say, and our return on equity, return on assets and all are closer to the like say top 5 in the industry and all. We hope we will be maintaining our identity as we have been being the oldest bank with over almost 120 years of existence, making profits and declaring dividends for all the close to 120 years. We don't feel any reason for that at this moment.
All right, Mr. Kamakodi, we'll leave it there today. Thanks a lot for joining us. Sometimes when you do something for 20 years and doing the same thing, maybe you're not doing too bad. You know, Nadal's been winning French Open for the last 20 years.
But the question is, will you be asking the same question for the next 20 years?
I don't know about that. Yeah, there's no way of knowing it. But by the way, just look at the market. It's really very smart recovery. And tell you what, today the Nifty is actually doing better than the Bank Nifty. And the reason for that is ITC. Just look at that phenomenal move. And not just ITC, yesterday Lever as well, Britannia. The FMCG index has been making some big moves. And I think let's pull out that FMCG index. I think that's really trading at the highest point. That's the contribution, of course, ITC being right on top. And FMCG index would come up for you. So that's doing quite well.
You know, the Nifty came within 10 points of turning green. So I think I
was just going to say that I'm going to win the bet. I hope you remember that. I stuck my neck out and said it's going to be in the green today. So just keep that present ready.
Absolutely. It's already there. Well, let's take a quick break here. We'll come back and we'll get chatting with our technical expert. Mitesh Thakkar is going to be joining us for that with some technical trading ideas. Stay tuned. The conversation follows.
Welcome back. Well, the market's been very strong. The mid-cap index is comfortably in the green, 1/3 of 1% higher on that. And the Nifty is just about 30 points off. Mitesh Thakkar is back with us. Mitesh, good going. I mean, this is a really good outcome given all the global sort of concerns. What next and your stock calls?
Yeah. Anuj, much stronger than what I would have thought in the morning. I think I did hear Prashant and Sonia bet it out that whether it will turn positive or not. We nearly turned that, but I still believe that the market, despite this intraday volatility, the overall market is still in a contracting kind of a zone. So 17,900, 17,500 broadly remains the range, and therefore trading is clearly more stock specific, or else if you get an entry closer to about 17,500. On the stock side, Marico is something, which is breaking out. That's a buy with a stop at about 535. Look for targets of 565 here. And the other one is Page Industries. In fact, there's been a call in the last 2-3 days as well. But even now, showing that strong continuation pattern, Page is a buy with a stop just below 51,200 for targets of 55,000.
Right. In fact, Page has been moving from strength to strength in the last few days. Despite all the volatility in the market, page has been hitting new highs. Thanks a lot for that. Let's do one thing. By the way, some news on SpiceJet. This is source-based information where SpiceJet has announced a 20% salary hike for pilots from October. This after asking 80 pilots to go on leave without pay for the next 3 months. So let's see which way it shapes up. But for now, I think trying to do some damage control maybe after.
Is this for those who are still there on the roll? I mean, this is, you ask some to go on leave, and the ones who are left to sort of boost their morale, you are giving the hike. I don't know. Strange ways the corporates work, right?
But it is strange, and we all know, I mean, look at the stock, right? It's down 40% this year because of the problems that SpiceJet is facing, and the management has said several times that they're looking for cost-cutting measures. So these are perhaps things that they would have to do. The fact that they've asked 80 pilots to go on leave without pay for 3 months, that was to bring down costs. But now the latest is that a 20% salary hike for pilots from October. All right. Anyway, let's move on. Talk about the commodity markets. Manisha Gupta is joining in. Manisha, what's the commodity you're looking at today?
Sonia, I'm looking at metals, and the 75 basis point rate hike was factored into markets, and we did see big shorts being created ahead of this event, and we have seen some winding up of those shorts as well. So some bit of a buying actually is what we are seeing. Call it a relief rally. Not the case for the gold prices, though. We are trading still at around those 29-month lows. But the important point is that here as well, we haven't seen newer lows being created. So we basically have held in that range of 1650 to 1675 on the higher side. The 75 basis point rate hike was well factored in gold and in silver as well, where we actually saw some 0.25% of a gain come in the international markets overnight there. Well, Russia also increasing troops in Ukraine is something that the markets are reading quite deeply into, and that's a concern that seems to be supporting the gold and silver prices, even as you have the dollar index trading at a new 20-year highs there. There also is an interesting report from Citi which says that they are not done with the sell-off here, and a technical support at 1650 and then is coming in at $1,600 per ounce. But they do expect the gold prices to do better in the fourth quarter of this year. That is when the festival demand starts coming in, not just in India, but the Christmas demand in the international markets as well. That is when they see the gold prices seeing some support. They also expect the prices to see stronger gains in 2023 and 24 going forward. For the base metal prices also, we have seen decline as the dollar has firmed. So the international markets, whether it's China and US, are trading on a weaker side. For the Indian markets, the kind of gains that you are seeing is because of the rupee depreciation here. The Fed's hawkish stance is pressurizing the global economic growth, and you will continue to see some pressure in many of these metals here. In all of these commodities, really, lead, zinc seem to be doing slightly better. Nickel as well has seen some gains after the Russian President Putin's statement yesterday of increasing troops in Ukraine. Nickel, remember, 10% of global nickel comes in from Russia, so that is where that commodity seems to be taking support as well. Interesting statements coming in from Rio Tinto, where they say that the copper is set for a short-term weakness here. They are looking at global supply disruptions, the weakness in demand, and that will continue to weigh. But Rio Tinto also says that get into 2023 and until 25, they are expecting the copper prices to double from here, and they expect the supply to be much higher than where the demand to be much higher rather from where the supply could be. So when you look at the slightly long-term view coming in for many of these banks, brokerages and mining companies, they are expecting 2024 and 25 to be the years when the commodity prices will be much higher from where they are right now. Take a look at the prices on where we are trading right now as well. Week on week, we were talking yesterday on how everything is in a negative. Month on month basis also, we are trading in the negative for many of these commodities. So when you look at gold and silver prices, gold actually has declined much more than what silver has done. So clearly outperformance coming in from silver. Decline in case of copper and iron ore between 6 to 7% in last 1 month. If you look at the other metals like nickel, aluminum, zinc, they actually have done slightly better. Nickel actually 8% up because of what Russia and Ukraine are doing. Zinc, aluminum continue to trade in negative today as well.
Right. Manisha, thank you very much for that. There's commodities very much in focus. The market's down, back down 60 after coming within 10 points of turning green earlier. So we'll keep track of that. Aptus Housing is the stock of the day, actually. It's a small name, small home financier. It's up 5%, was up 8 earlier. There's a brokerage which has initiated coverage with a buy and big price targets. Abhishek is here with what they're saying. Abhishek.
Well, Prashant, as you mentioned, Citi has initiated coverage on Aptus Value Housing, wherein they have a buy recommendation and a target price of 425 per share. They say that it's a highly profitable, affordable housing lender, and it has demonstrated quality underwriting with credit costs being below 20 basis points pre-COVID, and during COVID, the peak was around 86 basis points of credit costs. So good execution should enable a 29% CAGR on loan growth over FY FY22 to 24. So pricing power and efficient cost structure should help it deliver healthy or strong ROA than peers. So they have built in a 60 basis point net interest margin compression over FY22 to 24 on account of a higher share of home loans and the leverage that will play out. So they expect ROA of 7.4% and ROE of around 16.5% in FY24. So core geographies are quite underpenetrated, which gives scope for loan growth going there, as well as the fact that they believe that Aptus value housing will enter into other geographic presence as well, which will drive the loan growth ahead. Back to you.
Okay, thanks a lot for that. So that's 5.5% higher and big volumes there on Aptus value. Fortis is the other stock on our radar. Ekta is here to give us more. Ekta.
Thanks for that. Well, yes, definitely a big day which is coming in for Fortis today, because there will be the Supreme Court verdict with regards to the IHH open offer, which has been pending since December 2018. It is due at 10:30 a.m. today. Remember that IHH had bid successfully for Fortis in July 2018 for around 4,000 crores, which was 170 rupees per share. They were, so they hold around 31% stake at this point in time. IHH had to undertake an open offer for an additional 26% at 170 rupees per share, and IHH had around over 3,000 crores in an escrow account for this particular open offer. However, it was put on hold by the Supreme Court in terms of a freeze because of concerns which were brought out by Daiichi with regards to the deal. Now the company, however, if in case it does go through the open offer, the company says that IHH in fact is committed to Fortis, because there were concerns that IHH might in fact look to exit Fortis considering the uncertainty over the open offer in the past couple of years. But they are not looking to exit Fortis. Internal expansion also was not impacted because of the uncertainty of the open offer. Analysts say the open offer price could probably be the earlier open offer price of 170 plus 4 years compounded interest, which comes to around 250 rupees per share.
Okay.
Sorry. Ekta, thanks very much for that. So Fortis is likely to be in action over the next 15-20 minutes, the court decision, and then of course after that we'll see which way things go. Well, time for a quick break here. On the other side, our special segment, it's The Economy. We'll be joined by Samir Goyal of Deutsche Bank and Vishnu Vardhan of Mizo Bank to talk about the outcome of the Fed meeting and implications for markets. We're back with that in just a bit.